This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Andrew Joseph, who is no stranger to our Trigger Webzine subscribers and our now 4 times a week technical market alert updates. Andrew is principal of Golden Phi, publisher of the Triggers Media Publications Inc., and editor of the Triggers Webzine and website. Good morning, Andrew, and welcome.
Morning, Gordon. Thanks for having me back. It's great to be here.
We missed on Saturday with the ice storm up in Ontario, but it sounds like everything's back and running now.
Yeah, all the power is back up. We lost it pretty much for a day. It was a lot of fun.
Well, I apologize to our regular listeners of not having the tape on Saturday, but these things do happen. I did post the slides for everybody, and as we talk here this morning, we've got gold making some big moves, so some of those slides have even changed since the Saturday show. Before we get into our slides, I need to just review a couple mechanics regarding the slides. I would ask our listeners to open the slides to full screen viewing. You need to open the slides to properly see the detail we'll be discussing. There's an icon in the bottom right corner that by clicking it will allow you to do that. The slides will then obviously automatically advance as we go along. I need to be very clear that the slides, as usual and this morning, are for educational and discussion purposes only. They are not to be used for trading, nor are they in any way investment advice. They are solely for discussion purposes. Andrew, what I'd like to jump into is the slides so we don't run out of time. And the sequence that I was hoping that we could go through here this morning, I have up on the screen now, is to revisit the Ides of March predictions that we made in January and in February and we talked about last month, because they give us a framework from where we're going, because they confirm some boundary conditions, and we'll go through that. I'd also like to talk about the long-term perspective to put some of the shorter-term actions into perspective, because without it you can easily get fooled here at a particularly important point that's going on now in the market. I'd like to talk about overhead resistance levels and support levels, what the gold market and the gold charts are telling us, especially with some of the action we're now seeing here in real time. We've never seen gold hit the kind of selling that we've seen here in the last 3 to 4 days. I'd like to talk about the corrective consolidation diamond structure that I'm currently seeing and revised expectations and targets. Andrew, jump in any time here, but these are the charts that this first one that we showed back in January when we wrote a Triggers article on Beware the Ides of March. And we were looking for something in the area of 1562 as we got into March the 15th time frame. And that was kind of a bold prediction. Everybody was looking for a sell-off at the time. And last month we showed we were tracking very, very closely to completing that structure, as you can see here. And in fact, we did complete it. As we got into, this is showing on April the 4th, we actually were right on the end of closing that. And we're completing what was a right shoulder if we looked at that ellipse structure. What's important is it defined, as you look at those rings and the ellipse themselves, some very, very key pivots that now that we're at that point, doesn't mean that the top is now in. It means the top of this structure's in. And now we're going to start to move to a different structure. Any comments there, Andrew?
Yeah, this worked out pretty good for us. We've been watching this ellipse actually for a little while. We just showed our viewers just the last couple of months as to how it's worked out. And that we've actually now blown through the top of that a little bit. We're going to move on and show you some of the next slides of what we think is going on. But as you said, this is just the end of the one structure, and now we're trying to figure out what the next structure is going to be. And I think as we were discussing before privately, that we were looking at a more of a horizontal move to the right, and the next ellipse, next blue ellipse, like the one we're showing on the screen, will probably be horizontal in nature more than an angled. But we'll see how that goes. I'm going to work on some more of that this week, and our next session that we're going to have on Saturday with some gold charts, I may bring that up too to see what I can find.
Yeah, exactly. So on Saturday we'll be back with our second session here. We'll talk about gold specifically and the Forex markets. But this confirms a structure. And the next structure isn't independent. That's the point I'm trying to make here. It's very much dependent on this particular structure. How that unfolds, that's the trick. And we're going to give you a view of that. From a bigger perspective, we're going back here on this chart back to the late 1990s and the left shoulder at 2000 during the dot-com bubble. And we've been looking at a head and shoulders pattern. But I've been talking for some time that right shoulder here is really based on what I call delusional distortions, and that is the central bank printing. So what that final shoulder is going to look like has been debatable. And over a year and a half ago, for our subscribers who are well aware, I was predicting that one of the alternatives was a megaphone top, that either we were going to have the rounded top, a triple top, or a megaphone top. And that right shoulder is what determines whether it's going to be the third top, or in fact it goes slightly higher for a megaphone top. And in fact, on the S&P right now, we're seeing the megaphone. So it's reaching for that lighter line that's drawn through the left shoulder, the head, and going over to the right shoulder. The point I'd make here, though, this is just the S&P 500. If you look at the SPY, which is an options traded form of a spider, if you look at the OEX, or if you look at the SPC5 in the futures marketplace, you'll see different patterns. You will see some clearly showing the head and shoulders, some showing a triple top, and some like this suggesting that we've got the megaphone. If you look at the European charts of the various indices in Europe and around the world, you will see very clearly head and shoulders patterns, so that right shoulder hasn't come up quite as high. So I don't think it's as important right now to get caught up on what type of right shoulder we have as really what the structure is. I want to show you some charts, but if you notice at the bottom on the oscillators, it's suggesting that at least at an intermediate term, right now, we should have it high. We'll have volatility, but we should have another leg up. How big that leg is, we'll talk about, but we should have just a little bit more lift, and we should move towards that lighter line that's showing here. This is a chart that we've been showing for over a year now. It's showing Fibonacci time extensions. The one to look particularly at is the red at the bottom. And when you have Fibonacci extensions, when you have two lows, usually the third is then the high. As in the blue at the top was showing two highs, it's usually the low. And that's in fact what we had as we went through this mechanic. So I've been tracking this. And you can see right now we're at the point where we should be putting in at least an intermediate top on this long-term structure. That doesn't mean it's the final top, but it's in this particular range of this week, this part of April, that we should be seeing this intermediate top put in. The two H's that we've drawn for, I guess, Andrew, best part of 10 months, and it was going to be somewhere in here. And that's what's unfolded. It's unfolded just beautifully from nothing more than Fibonacci time extensions in the delusional distortions that we were trying to accommodate because we weren't quite sure the degree of which we'd have monetary malpractice and the distortions associated with the money printing going on. Remembering these charts are nominal charts, not real charts. Now, if we go to this particular chart, when I've taken out some of the labeling we had previously, and I've heightened the dark line in it, it says that we probably should move up to touch that. And you can see the dark black line of a structure within a channel. We're looking at this a little bit differently. It suggests that there's probably an extension up through that. And if you look at this channel of the last leg, it really shows how structured and controlled it is in working at a narrow band.
Looks pretty managed.
Exactly. And in fact, it is managed. And I say that in the context that what we have here is a classic historical short squeeze. We've been operating here pretty well through the beginning of the year of a very managed short squeeze, and anybody who's been short has been absolutely killed. But that also means that when you have that degree of short in, it typically then leads to the public starting to get in. And that's what's trying to be orchestrated here. And you're starting to see the public, who always come late to the party, now suggesting they should be in the market. That's, from a contrarian standpoint, says we should be at a peak and a contraction back.
Interesting what you talk about with the short squeeze. What we're seeing in gold right now is just almost the opposite, what you could say. We've had a huge spike down. But again, that could be getting ready to lift and getting all the longs out. The long squeezes, maybe you might want to call it, to dump down. And it's coinciding with what we're seeing in all the other markets with respect to the S&P as well.
From the central bank's perspective, and they're in the money printing business, they're in their, the Federal Reserve note is their product, as is the euro and the ECB. So gold is the enemy. Anything that's a hard currency, commodities, something that stores value in another way other than the currency, to them, in effect, works against their currency. So what they want is they want markets up because they're asset values, and the asset values are collateral. And the collateral is what supports the debt, which supports the bond market, which is what they're selling. They're selling debt and managing debt on behalf of the government. So they want the market to continue to rise to support. It's not so much the absolute value. They just don't want the asset values that are being used as margin and collateral to force a contraction and deflation. On the other hand, what they want to do is they want to crush gold in any other form, even bitcoins or whatever, so that there's not really another alternative. And that's being very well managed, and we've talked about this quite extensively in our various reports going on for best part of a year now. And I think they've done a very, very good job of it because commodities are being beat down too. And I see this happening, continuing to happen for another 60 to 90 days as we get more people that are beat out of the gold market, more people believing that they're missing a rally in the stock market. I'm not suggesting it's going to rally in the next 60 or 90 days. I think there's a consolidation pattern we'll see, but there is another leg up, I still believe. If we move to the next chart, Andrew, just as a springboard, you can see that I drew another leg in, and you'll notice these legs are beautifully symmetrical, beautifully parallel, and fitting within the channel, which is giving us more feeling that there might be more lift left to go. If we step back and we look at the Dow, not the S&P as we've been looking at on a very, very long-term chart, and this is going back to the 1980s, we see a channel in here and up on the top with the red, which is suggesting there's more to go in the Dow, which is in the 16,000 range, and also suggesting from a timeline standpoint that that's later into the fall. So there's another lift if these structures are going to tie together to say we're finishing in an intermediate time, but there should be another lift to come. This ties in with the macro because I personally believe, and we've talked about this previously, and last month's triggers we laid out quite well, the expansion in the balance sheets of the Federal Reserves, of the central banks that is, and there's another round of reflation yet to come of something called OMT, overt monetary financing, which is going to be simply outright monetization. And that will give us probably that next lift. That's what it's suggesting to me. And the gold charts have been telling that. And we've had a classic consolidation pattern here that has been unfolding, was suggesting a CD wave and then another lift later on in the year as they go to this next round of massive reflation, as we see a scare in the equity markets or consolidation. What's happened here as of this morning, Andrew, is we've actually had them crush gold. Gold's trading just north of $1,400 an ounce. And I just laid it on here before we started, and you can see that we've almost got a classic ABC pattern. So we could have a lot more, or not a lot more, but we could have some more downside here on these particular legs. Any comments on that?
Yeah, we're still watching that. We're at right now close to some major supports. Anybody who's been watching my gold charts, and again, like I said, I'll update this for the weekend coming, but we know there's some Fibonacci circles going on there. And this last break that we had of the pennant pattern we're looking at actually fell down and is almost at the next Fibonacci circle, which is telling us to expect some consolidation.
I think as of this morning, we're almost within your high probability training zone target, not from time, but from price.
Oh, we've hit the price level already, yeah, definitely, and now we just got to see it. That's why I'm calling for a little bit of consolidation, because the market needs to move over to the right to hit that target zone. Because if it doesn't move over to the right, then that means it needs to break, and it'll go down to the next Fibonacci circle, and that's way down at 1100, and I don't really see that yet. I mean, it's possible. We're watching, but right now we're looking at the consolidation at the current level around 1400.
Yeah, if that was the case, then this ABC would be a Fibonacci extension, and that C wave would be proportionally larger to take it down. We're actually going to lay that out here on Saturday.
Again, really shows us the importance of part of the strategy that we're using at Triggers and that we promote. And that being is if anyone who was looking at our charts, at the base I had a bounce for a D, and then I also had a drop for the C that we're into. And I said it's going to do one or the other here, and the only way to know, you can't know, but you can trade it and play it with the triggers. When that, for example, the base breaks and did break on gold for what we're looking at here, and it came down to the C level, that break was a trigger consideration. And then if you had caught that, well, it was quite a dump for anybody who did use it.
Andrew, what's going on here for those who don't watch technical analysis as much? The patterns are very predictive, but they can change dramatically, but it doesn't necessarily change the bigger picture. So even though we had a consolidation, a diamond pattern, which often just plays out exactly as we had, then will change, as we're just showing, and change fairly significant. But it will not change the fact that we'll still get this lift we're showing on the right-hand side.
Still a consolidation.
And it'll be a consolidation at a slightly lower point because the gold market is one player in a much bigger set of markets, that is the bond market, the equity markets, the currency markets, as they all come together. Now, what's at the root of this, in my mind, with what's happening with gold? It goes back to, as we've talked about, the major inflection point what we've seen in the treasury markets and in the bond market, and it goes back to Japan and what's going on with the dollar-yen cross and the euro-yen cross. And we've had many discussions, and you chart these quite accurately and regularly. And so we've had incredible volatility in the last couple weeks in the yen, and as the yen has absolutely been crushed intentionally, as the Bank of Japan have announced massive monetary stimulation, have actually come out with it now as a policy, not just something that was being talked about, and the markets are reacting to it. And the ups and the downs that have happened with this have been truly significant. Now, what's this mean to gold? Well, when you're in the investment banking business, in the banking business, you have to have so much assets that you have to have, I'll call it as reserves or on the books, that is measured against value at risk, what they call VAR. So when you get massive moves in volatility, and specifically to interest rate volatility, as you're seeing on the JGBs, the Japan government bonds, that means that on your books you have to adjust for that risk because you now have increased risk and therefore the value has to be adjusted. To do that, you have to sell product. You have to have more cash, more asset. And so they're reacting. So there's a selling process that's going on to manage that increased volatility in Japan right now. That doesn't necessarily mean they're just selling gold because of it, but as a consequence, gold is one of the assets that's getting hurt. But it's also, you'll see it right across commodities, you see it across silver. But that, to me, is what's at the root of this sudden and dramatic shift that we've had. But I think that the charts will play out, as you just said, as we get a consolidation and move to the right. But in a bigger pattern, and more of a consequence here of what it means to the equity markets. It is sending a signal that there's going to be more central bank action at a higher level that's coming. Well, on the left-hand chart that I have up now, Andrew, I'm showing a wedge that we've had in this last leg. And you can see that the circle is indicating we broke through that wedge as we went towards that blue timeline on a Fibonacci extension. And it says, that wedge didn't work out. What happened? You had a throw over. My experience has been, and it always seems to work out this way. If you go to the right-hand chart, that same circle now becomes a support line for that black line, that black upper trend line. And as they connect the bottom set of lines, you'll see we have a new wedge. So what happens is you've mutated so that the market should come off from that circle on the right and move towards that bottom black line in more of a horizontal fashion, some down, some up, but very volatile, before we have the final lift and move up towards that apex, not exactly to that apex. So to me, this is another clue of what might be happening here. So what I've done is I've tried to connect what we've talked about in clues into what this pattern would probably look like. And this is what I think it looks like to me currently. We've had an A, B, and now we're finishing a C wave at somewhere around 1600. We're a little below it. We may get a little bit more upwards of it. It could possibly get high as 1620, but I think we're probably there now. It's somewhat irrelevant, but we're going to move to the right as labeled here as a D. There's something for those who understand Elliott wave, which is a very strong rule and works out pretty well, is something called alternation. And that is when you have a fairly significant correction, like we see down on the lower end of the AB, the B wave down, usually the CD wave, or the corrective wave here, is going to be flat. So if one's flat, the other will be significant retracement and vice versa. So this should be something that's flatter, but certainly highly volatile as we move to the right in time. And then we should see another lift, and we can debate how big that lift is, but it will be in the September Q4 kind of time frame, which maps into the previous charts. It could suggest on this diagram that we get upwards in that lift of 1700. We will do a little bit more work as we work along, but it's really to identify that there's another lift in there. Any comments on that, Andrew?
The chart we're looking at now, you note that the lifts and the moves are getting smaller and smaller and smaller as we get into this wedge, as you identify. And so what you're saying about this next lift, it shouldn't be very much longer. It shouldn't be another huge AB that we saw at the beginning, just finishing off the structure as it is. Otherwise, we're looking at a whole new structure that's going to start out of this.
This is a termination pattern. It's been very clear it's a termination. All we're grappling with is the time and the final price on the termination. And this just becomes more and more reinforced over time. Otherwise, we would have broken these patterns significantly. And a lot of these we've been mapping for 2 years, Andrew, and they've been mapping very, very well.
Exactly. I think we've had originally we had an ellipse on there that we've moved out of, but that still is not in play anymore. It's just that we've lifted out of it slightly, but we could come back into it at any time.
Let me go back to the Dow. I showed this chart earlier. I've just taken that current thinking that we went through and said, well, what would it mean here? And we have a megaphone I've drawn in with red on that Dow, and you can see the CDE, which is into the late time frame. So it suggests to me that to complete that pattern, it's the pattern we just talked about on the S&P. It would look something like this.
And at the same time, what we were talking about with respect to gold before, that gives it time to finish off, to come over to the right before we get another lift.
Another way of looking at this, and let's go back to, we talked about earlier, the ellipse that we had in the Ides of March. So here we are, it's finished, and you can see a little green spike where after we finished it spiked up. But if you were to use Fibonacci spirals that we've laid in here, that you've laid in, Andrew, in green, and I've labeled the loops here 1, 2, 3, 4, and 5 in red. What's important is when we draw there's a circle at the top of the ellipse, that in fact the spiral then starts from the center of that. It then cuts beautifully every major inflection in the last leg. And that's the confirmation you need to have to start to project what that structure's telling you going forward. So the circle tells you how to, in fact, the black circle, where to center the spiral, and the spiral where it intersects tells you how valid that particular spiral is. Now, what good is that? Well, that spiral then starts to allow you, with the alternation, to lay in some boundary conditions of what the horizontal movement might look like. And what consolidations are, and that's what we have here, a corrective consolidation. They always take the shape of a diamond. So laying that out, it would suggest that we should see this kind of diamond. And sure enough, when we look at it, there's your high probability trading zone. We went straight up to it. As soon as we got in it, we started on our way down. And it's somewhere in this labeling, it's generally what you start to see unfold. And we'll be looking to see if this unfolds in this manner with this up-down structure. The other thing I'd point out, Andrew, is your ellipses that you have in here labeled the Fibonacci ellipses. The outer rings, which are more accurate, also tells us the level of what the right side of that diamond should end at, and then we start to see another lift up for this E wave that we've been talking about. So we have a lot of different confirmations that are sending us some signals of what we should be expecting going forward. And I've kind of rushed through these because I wanted to make sure we had enough time to touch on them, but it's sending us some pretty strong signals. Comments?
Yeah, as of this morning, actually, it's 10:30 on Monday morning. We've come off the target zone at the apex of your diamond that you have there, and we've started back down towards the bottom blue channel. We might even be breaking that now, actually. So we'll see how much lower it comes down. I'll be doing some more assessment for subscribers tonight and putting out an update, inter-issue update, to see how we can target this as to what the movement's going to be.
You'll have your charts out through the week on all of this. My technical analysis matter report is out, which takes a lot of the backup for this and specific targets. But I think this allows our listeners to get a general idea of our current thinking and what the macros are telling us and what the drivers that are behind us, so we didn't get into it today, are also telling us. We're out of time, Andrew, so we have to break, but I'm really looking forward to our second session here this week, where we're going to get into gold, Forex, and then map over top of what these charts are telling us. Before we break, I need to restate and make very clear that these slides this morning are for educational and discussion purposes only, and they are not to be used for trading, nor are they in any way investment advice. They are solely for discussion purposes. Any final comments, Andrew, that you'd like to make?
Oh, no, thank you very much for having me, Gordon. I'm looking forward to the end of the week when we try this again and see how it's all panned out and how the rest of the market fits in.
Talk to you then.
Take care.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.